Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. It's been another remarkable week in the financial markets, dominated not for the first time by President Donald Trump, who used an appearance at the United Nations in New York to deliver a rambling and somewhat surprising 1-hour rant in front of the assembled delegates from other nations, including a number of contentious claims, such as that London is poised to introduce Sharia law. It's the kind of inconsistency and rather confusing backcloth which has dominated the financial markets all year. But yet, it seems to be very welcome in the stock market after the initial shock of Liberation Day with that imposition of global tariffs on most of its trading partners. The US market continues to hit new all-time highs, as does in the investment trust sector. Some 25 trusts out of around 250 names also hitting all-time highs this week. And 72 trusts, by my count, also hitting one-year highs. Now, my guest this week come from a trust whose share price has not hit all-time highs, but who has put together a very strong and consistent record in its time as an listed investment trust. I'm talking here about TwentyFour Select Monthly Income Trust, ticker TFIF, which is one of 5 trusts that sits in the debt-structured finance sector. We'll be talking about what that actually involves in a moment, but essentially this is a trust that pays out most of its earnings as income, currently yields over 9%, and has, as I mentioned before, delivered a consistently high return since it did its IPO back in 2013. So notwithstanding what's happening in the equity markets, we've also seen a phenomenon of falling short-term interest rates but rising long-term rates in the US and indeed in the UK. So what does that mean for this particular trust, which invests in what are called asset-backed securities in the UK and Europe? Well, to talk about all that, and I hope to explain some of the jargon that I've just used, I'm delighted to be joined by Bronwyn Curtis, who is the chair of this particular investment trust, which has a market cap of around 850 million, and Aza Teeuwen, who is one of the fund managers on this particular trust. I started off by asking Bronwyn Curtis, as the chair of this trust, what it does and what is distinctive about it.
Let me just start by saying TwentyFour Income Fund invests in higher yielding, floating rate West European asset-backed securities. It pays out all of its income as dividends every year, so the dividend's always completely covered. Aza can go into some of the details on what he actually invests in, but just to say the fund itself, when it was launched in 2013, the target return was 6 to 9% of the issue price. It's always met its target return every year since then. It's asset-backed securities, but it's never had a default in the fund. We are currently targeting 8%, so 8p, which is we do 2p every quarter, and then we have a balancing quarter in the fourth quarter. So the balancing quarter at the end of the last financial year, which was January to March, we ended up returning just about 10% to shareholders when you added it all up, because we always tend to deliver more in the final quarter.
Okay, so that's a splendid record so far, as you say. Before we go on and talk about exactly what you invest in, can I just get some context around the point at which this trust was launched? Now, I imagine that this had a lot to do with the fallout from the global financial crisis, which led to a lot of things changing, including interest rates coming down, and also a lot of specialist asset classes that had been mainly managed and developed by the banks. They stopped doing that. And therefore, this became an opportunity to create a different vehicle in which to invest in this higher yielding asset class. Would that be a fair summary?
Yes, that's a fair summary. I think all of the people at 24 Asset Management, and Aza can fill in the bit, they are all specialists in asset-backed security, high-yielding credit, because that's what they were trading during the financial crisis and before it, and they saw an opportunity. When the fund was launched, it was launched in 2013 at 150 million. So it was relatively small, but it's grown quite quickly because we're up at about 850 million now. And the growth has been a combination of trading at a premium. So we've been issuing stock. We also took over UKML, another fund, which is another 150 million. And we have every 3 years this realisation opportunity, which sounds a bit weird, but basically, every 3 years, there's an opportunity for anyone who owns shares to sell their shares back to the fund as much as they want at net asset value minus costs, which is about 2%. It's also an opportunity where if we're trading at a premium and they want to buy, they can buy at net asset value plus 2%. So the idea was this was put in place as a discount control mechanism because we didn't want it to trade too far from NAV. And as it happens, in 2 out of the 3 realisation opportunities we've had so far in 2016 and 22, we've raised money. And the reason this is relevant is because next month we're coming up to another realisation opportunity. So we're trading at a 1.5% premium at the moment. We've delivered just over 7.5% on the fund year to date. So it looks pretty good at the moment.
Right. And that's one reason why I'd be very happy to have you on the podcast this week, because, as you say, this realisation opportunity is coming up. The trust has performed very well. And obviously, you have an interest in, well, you'd like it to grow again, I'm sure. And we'll talk about that. Not many people, perhaps, or not as many people as you might think, are aware of what's been going on in your sector and indeed your track record. So why don't we dive into that? As you say, you've delivered on your prospectus, you've raised some more money, and you have a significant market cap around 870 million. But all of which then comes back to begging the question of, well, what actually are you investing in? What is an asset-backed security? I guess if you were a cynic, you might say that sounds rather like a slightly, what's the word, sort of dressing up something which it isn't. I mean, most securities are asset-backed, not all of them, but most of them are. It's actually describing something which is a lot more complicated than your average investment, which is why if you want to invest in your trust, you have to sign a disclaimer on some of the platforms that you understand there are complexities involved. So let's get into that, because I think anyone who isn't familiar should actually know, first of all, let's start with what is an asset-backed security. And I'll ask Aza you to answer that one. Give us a concise definition.
Absolutely. I think asset-backed security sounds probably a lot more exciting than it really is. Because if you break down what an asset-backed security is, it's good to take one step back. Because what does an asset-backed security finance? We finance things like mortgages, consumer loans, auto loans, as large senior secured corporate loans. If you think about how a bank, if they lend money, they need to finance themselves. And a bank can do that in a couple of ways, either deposits, central bank funding, senior secured assets, or senior secured bonds, covered bonds. But banks can also issue asset-backed securities. And the beauty about an asset-backed security for a bank is that they take a pool of mortgages that's on the balance sheet, place that into a new vehicle, bring it off balance sheet, and raise funding against it. Now, what that does for a bank is that they match their assets and liabilities exactly. Because as an ABS investor, we don't finance banks, we finance assets, we finance mortgages, for example. And what this does for a bank is if they have a pool of, let's say, 500 million pounds of mortgages, they can raise, let's say, 450 million of debt against it and 50 million of equity, which they will keep. Right? It's just a balance sheet ultimately. And that matches exactly the assets that they have. So if the mortgages repay, people move home, so they refinance to different banks, then they tend to repay their mortgages, bonds get repaid. So ultimately, an asset-backed security, or an ABS as we like to call it, is just a balance sheet where you've got your assets, which are your mortgages, and you've got liabilities, which are made up of different bonds and an equity tranche or capital that's provided by the bank.
So who in this setup is actually taking the risk that the mortgages default effectively?
Ultimately, everyone, the bank or the lender in general, tends to take the first risk. They capitalize these vehicles, so it is a pure funding trade for them. Ultimately, if losses on mortgage pools are larger than the capital that the bank provided, then obviously bondholders are at risk. But that's no different to any other corporate bond or a senior secured bond from a bank.
So I think people will still think, though, that, they've read about the global financial crisis. They know that one of the things that went wrong was that the banks were doing lots of things with exposing themselves to mortgages and other securities of that sort. And it all went wrong and blew up. So what is the underlying risk here? Is there any risk of this happening as far as you are concerned? If it did happen, what would be the impact on you and what would be the impact on the banks?
I think that's a good question. And I've also seen The Big Short and I've read it. I think that very much applies to the US market. Like in the US, there were very significant losses on subprime mortgages, product that doesn't exist in Europe. There were a lot of losses on things like CDOs, which again don't exist anymore. Ultimately, if you compare losses or credit losses in Europe to the US, they're virtually non-existent in Europe because ultimately there is just a lot more protection and it's a very different product. So if you have a mortgage in the UK or in Europe, doesn't really matter where it is, as long as it's the UK or the EU, then that is a full recourse mortgage. So that means that if I have a mortgage and I stop paying my mortgage, the bank won't just seize my house. They'll also say, hey, Aza, you've got a car, you've got a pension, you've got an income, you might have a future income, and they will come after all of those assets until they have recovered the debt. So that incentive to not pay your mortgage in Europe is incredibly small. It does happen. People do lose their jobs, unfortunately, but ultimately, actual credit losses were incredibly low in Europe. And in fact, in ABS, credit losses were a fraction of what they were in similarly rated corporate bonds. We think about things like a CLO, where you're financing senior secured corporate loans. You look at S&P's data on 10-year cumulative default data, you can see that even in the high yields part of the market, high yield CLO defaults were a fraction of what they were in high yield corporate bonds. And yes, things can happen. Ultimately, you're invested in high yielding bonds. So yeah, defaults do unfortunately happen. But as Bronwyn said, the trust has not had a default since it was launched. But what can go wrong is things like a very significant recession where an incredible amount of people lose their jobs and house prices at the same time plummet like a stone. If we do stress tests on these pools of mortgages, then your average double B would need to have 2 to 3 times a global financial crisis type of stress to lose money on those transactions. Clearly, if we are in a GFC-like scenario, spreads will widen and mark to market or the prices on bonds in all parts of the market will fall. I think that's probably your bigger risk. Does that mean it can't happen in the US? Like regulation has moved on in the US, it's become a lot stricter, but regulation in Europe around not just mortgage lending, but also around securitization, which governs the asset-backed securities market, is significantly tighter than it was during the global financial crisis.
So, if I can paraphrase that, I hope I'm doing this correctly. It's not that there isn't risk involved in investing in these things, but the kind of risk that we saw materializing in the global financial crisis is, as far as you hope, relatively remote. Would that be a fair summary?
I think that is a fair summary. Like risks exist, right? If you're investing in a product that yields over 10%, risks do exist, but they're controlled risks.
Right. So, where does this 10% yield come from? In what form is it delivered? And how has it managed to be quite so stable over this period of time, long time now?
It's mostly just coupon, it's income on the bonds. So this trust was not designed to be a GFC recovery play. And it's always looked to generate a healthy income from lesser liquid, high yielding aspect securities. So if we are investing in double Bs or single Bs, then the average coupon that we get is SONIA, so UK base rate essentially, plus a spread. And currently, that is sort of 6 to 7% over the UK base rate. So that also explains why income on ABS, and particularly in sterling, has increased from 2022. When interest rates increased, coupons that we receive on the bonds have also increased. Clearly, the Bank of England has cut rates to 4%. So that means that our income has been shrinking a little bit. But the chance of us going back to close to zero rates is pretty unlikely as well. So it really is just income on this.
Okay. I mean, that was my next question, which is What is the determinant of the kind of yields that you get on these things that you're investing in? The coupons, if you like, where do they derive from? What is their relationship to interest rates generally? So you've described what happens when they've gone up, and you say it's not going to be the same as the GFC if they go down. But is it just the fact that credit spreads have narrowed significantly that is enabling you to keep this high level of income coming in?
I'd say in the high yield market, high yield ABS market, the spreads have moved around. When everyone is looking for yields, spreads tend to compress, but they have been sort of range bound. So let's take a double B rated CLO, for example. They've been trading at 5 to 8% over Euribor. And it's been in that range. We're probably at the lower end of that range now. In general, let's say valuations on fixed income and equity are high, but that is still good quality income that you're making there.
So perhaps I could ask you, Bronwyn, then, as the chairman of this trust, what is your argument vis-a-vis offering this particular trust to private investors? Are you looking for them? Do you welcome them? And if so, what steps are you taking to, if you like, make sure that they are not taking on something that they don't really understand?
So in the past, well, it's often been institutions and wealth managers who've bought this product. But more recently, we have had much more interest from retail. And one of the reasons is because even when rates were zero, we were still able to deliver at least 6%. So that's 6 to 9p of the issue price. And I have to say, my very first question when I was approached to be chair was about defaults. I went through the global financial crisis. I knew about US asset-backed securities. I asked an awful lot of questions about the sorts of things we invested in, the amount of research that went on in terms of looking at the institutions that you're buying into. And so it's quite a research heavy investment, in terms of the people. So I feel quite confident, actually. I look at the track record. I look at the default rate, which is for us is zero. We don't take the highest risks. We don't have the highest risks in our portfolio. It's mostly about double B, Aza. I'm right, aren't I? I hope.
Yeah, that's the average rating.
Yep. And I think we're quite careful about what we deliver, but it is very attractive for a retail investor because if we're delivering over base rate 6 to 7%, it's floating. So, well, the interest rate risk is all at the short end, and we deliver all of our income every year. I think that it's an attractive proposition. And I think what we've seen from 24 Asset Management is that they evaluate all of these very carefully. And it does change, doesn't it, Azza, over time, the sorts of things you invest in, depending on the price, newer products have come out. You look at those very carefully and decide whether to invest in those and so on. So I feel this is, it's asset backed. So it's not as if you're just taking a punt on, if you want to take a punt on crypto, that's fine. But you're not taking a punt in the same way you take a punt on crypto.
Right. But I guess the sort of comeback to that would be, well, 10%, is that too good to be true? In other words, can it really be that good when you are investing in what are not ultimately investment grade bonds? Can it really be that good, or does it need to be that good in order to justify the risks that actually haven't materialized for the last few years?
It's probably the same as thinking about senior unsecured from a bank, right? Your senior secured is always going to yield less than your unsecured. The same in any corporate bond. You have your most senior bond, it's not going to yield very much. You go into high yield, is going to yield a lot more. And the same goes for asset-backed securities. A typical transaction will have, let's say, 500 million pounds of assets, of mortgages. That's funded by issuing AAAs, AA rated bonds, single A's, triple B, double B bonds. Triple A's have got the lowest yield. They are the safest, almost impossible to break, but they are the typical product that a bank will buy and they will use it as repo collateral with the Bank of England, for example. But they might get paid SONIA plus 50 basis points. The blend of what the bank pays on those bonds from AAA to double B matches exactly what the mortgages pay. So let's say a mortgage pays an interest rate of, keep the number simple, 5%. Your AAAs cost you 3%, and your double Bs cost you 7%. or 8% or 9%, the blended will be exactly the same. It's a balance sheet that's in balance. It does mean that you are much closer to the bank's interest. Right? If you're a double B investor, you are lower in the waterfall of money coming back from the mortgages to repay your liabilities. So you are closer to the equity, but as a result, you're getting paid much more income. I think Bronwyn mentioned it, but where I think where ABS stands out in terms of us being able to analyze these assets is that following the global financial crisis, every lender that brings a transaction to market has to own 5% of economic value in that transaction. So the lender, the bank in this case, is very strongly aligned with our interests. That's there by law. It's been agreed by the Bank of England and the ECB. But what banks also have to do is provide investors with a monthly investor report, but also a monthly loan tape. Now, a loan tape is nothing else than a very, very large Excel file that tells us exactly who you're lending to, who the bank has lent to, so what your assets are. So we'll know from every single borrower what their income is. We'll know if they're up to speed on payments on their mortgages. If not, how much have they paid in terms of what they were due to pay? What's the valuation on the house? When have they bought the house? What's their income? What kind of income do they have? What interest rate are they paying? Are they paying a repayment, interest-only mortgage? Where are they based? You know virtually everything there is to know about someone other than their name for privacy reasons. But that allows you to do all kinds of stress tests. So if you go back to the Brexit referendum, where, for example, we would have been nervous around a certain parts of the UK where you have manufacturers that are exporting to Europe, that at the time allowed us to say, okay, what is our exposure to people that live in those areas that have a relatively high loan to value, maybe a slightly lower income, and say, what is our risk there? And to do very specific stress testing on that. The exact same stress testing the Bank of England will tell banks to do themselves as well. And I think that is the beauty. You've got so much data, and it allows you to do so much credit work. And the more data you have, the more historical data you have from a bank, gets you much more certainty. Clearly, if unemployment booms to 20% and house prices drop by 50, yeah, then you're going to be nervous around owning your double Bs. But that is not our outlook for the UK.
So these are many of the things that should have been done before the global financial crisis. But what, if you had that information before then, this opportunity wouldn't have been available, or would it?
I think the global financial crisis was where this was very different, is that you had plenty of banks that owned assets on 100 times, maybe 200 times leverage, and that leverage was there on a daily basis. And when that leverage was pulled away, or that funding was pulled away, they have had to move assets into bad banks. Ultimately, all the assets that went into bad banks were mostly money good, because the cumulative loss ratio, the cumulative default rate in Europe was less than 1%. So yes, a lot of these assets have been moved into bad banks, or banks were forced to sell because banks were being unwound. I think there, particularly the Bank of England and the ECB, could have done something else that they did later, and that is opening sort of a liquidity window for those banks where they could pledge those securities against funding for the banks, which is what they're doing now. So if a bank owns, let's say, I don't know, 500 million or a billion of AAA UK RMBS bonds, and those are residential mortgage-backed securities, they can pledge those with the Bank of England to get funding, instant funding. That is probably something that should have been in place a lot longer ago. That doesn't mean that that opportunity wouldn't have existed back in 2007 or 8. And when TFIF was launched, it was 2013. And by then, you kind of knew where these assets were going. Right? There were no assets trading at silly cash prices. Good quality bonds were already trading at 80 or 90 cents on the dollar. So, yeah, by no means was this a recovery trade. If only it would have been live in 2009. Yeah, you would have made a fortune.
You are listening to our Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole. and many other regular features, including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. So this investment trust, it sits in the debt structured finance sector, and that consists at the moment of 5 investment trusts, none of which as large as yours. What are you doing that is different from what some of those others are doing? Are they actually comparable, or are they doing different things to you?
Now, as far as I know, they're doing different things. In fact, because I always like to know what the competition is doing, we've tried to find comparators, and they are different. I think we're probably the most successful. I think we're probably more straightforward, some of them quite small. And we've even looked outside the debt sector, looked outside that and say, okay, so what else is there out there that delivers, say, 10%, it's regular income, that sort of thing. There are infrastructure funds, there's biopharma, there's a few things like that, but they're trading actually at very big discounts. And so it's not the same sort of thing. I mean, because we're floating and because we deliver all our income, we mostly trade around par. Actually, when discounts blew out during the Saba affair, when, they went after a number of funds, we did actually go to a discount of nearly 5%. But it came back in, because it's attractive. And we're back to trading at a premium and issuing stock. So as it might have more of you, but they tend to be very specific, a lot of these funds. I mean, ours in some ways is a lot broader, even though we're sort of average double B. There are a number of places we can go to get the stock that we need.
Yeah, I think where some of the difference exists is that TFIF is slightly, if you look at the investment portfolio, slightly lower risk. There are some funds out there that really only invest in sort of first loss tranches or things like CLOs, whereas TFIF has quite a broad remit. It can do anything in asset-backed securities, essentially. I think one other thing purely on the fund that is different is, and this is pure factual, is TFIF issues a weekly NAV and it publishes a weekly mark-to-market NAV. So you'll know exactly what the value of that underlying portfolio is on a weekly basis. Whereas I think if you look at a lot of the peers in this space, and maybe because they're invested in even lesser liquid assets, but their NAVs are static. They're just at par for life. It's sort of an impairment NAV. Whereas you look back at 2020, 2022, when markets were volatile, TFIF's NAV was equally volatile. I think that is a very big difference to some of the other trusts out there.
Because I guess the flip side question to that is, well, if what you're doing is so successful and relatively secure, why aren't more people doing it?
You do have a lot more investors in this space. I don't think any of them manage a trust. The investment trust market, and Rob will know that a lot better than I do, has probably had its own difficulties.
That's for sure.
There are other investors, aren't there, as
Oh
in
yeah, a lot.
areas that you invest in, and there have been more, but it may be a private I don't mean private retail investment, but companies investing in these things. So there are more people, but the market's also bigger, isn't it?
Yeah, we've got a market that's about 600 billion euros in size. I say the largest investors in our market are pension funds, increasingly insurance companies. So it is probably a bigger market where you have more professional or institutional investors than sort of wholesale clients as a broad market.
Yeah. So that then deals with my second question, which is, if presumably, as I said, you want to continue to grow the size of this trust by issuing more shares, and you hope that's going to happen when you get round to the next redemption realization opportunity. There are no capacity constraints that you can see at the moment. In other words, there are enough things extra you could do if you've got more demand coming in.
I'd say there's always capacity constraints on anything you do. I think we're quite far away from that personally. Maybe just to take you back to TFIF's history, TFIF for a period of time back in 2016-17, trading at a very significant premium because we didn't want to take more money in. And TFIF has not taken money in if there's no opportunities to invest in the assets. We do have a growing market. So I'd say for quite a few years post the global financial crisis, the market's been shrinking because banks have been funded by the central banks directly. And I'd say since 23, since we've had the end of QE, a lot more banks are going back to traditional funding tools such as ABS. So we've got a significantly, a sort of rapidly growing market. So the opportunity set is definitely broadening. But yeah, to everything, there are capacity constraints.
Also, when we issue stock or when the broker comes to us and asks, will we approve the stock issuance? It's not just the board, it's also TFAM, Aza usually, who decide whether they have capacity to actually invest in. And that's been pretty good. I don't think since I've been chairing the board, we've ever had a problem with you not being able to find something to invest in. Yes, we'd like to be bigger, of course. And we're issuing stock even now. So we've been doing quite well doing that. We hope the realisation opportunity will see more people wanting to buy stock. That would be terrific, like we've had in the past. But, I think because we're pretty tight around NAV or we trade at a premium, usually, it gives us the opportunity to get bigger all the time.
Yes, I mean, that is something of a privilege now compared to others, because it used to be the case only, 4 years ago, that more than half the trusts across the whole universe are trading at a premium. Now it's only about 30 altogether, and most of them do offer a pretty good yield. I think that's fair to say, and you're obviously one of those. Do you have any issues with the way that investment trusts are regulated? Have you had any issues with being able to communicate with the potential investors you want to invest with? Or have any regulations that you had to push back against?
I think the Association of Investment Companies is on top of that. I think actually investment trusts generally have had a sort of recognition problem in the past. It was, I think, regarded as a rather sleepy sector. But actually, when you think about it, it's the ideal thing for long-term investment. You can take in money, you can invest for the longer term, whether it's in infrastructure, whether it's in venture capital, and so on. So I think it's a really good vehicle for where you have slightly less liquid assets. And I think that's probably not recognized as well as it could be by regulators, by governments generally. I think there are times where they'll regard us as a complex structure. And you think, well, actually, it's not that complex, but just the sort of understanding of it. It's a bit like, I always think, the difference between buying an equity and buying a bond. And people think, oh, buying a bond, now that's more complicated because they have things like duration and yields versus price and so on. You buy an equity, it goes up or down. And so I think investment trusts do have just an issue with the regulators and others understanding that actually this is a much better and should be a more attractive asset class.
Well, you're preaching to the converted, obviously, on this particular podcast, because you won't be listened to unless you do believe that investment trusts have got something to offer. And of course, it's been through a tricky period with the number of trusts is shrinking by around 20% so far in this higher interest rate world. But you are clearly one of the beneficiaries of that change, as well as one of the advocates for the structure. So what will you regard as a successful outcome to this realisation opportunity? I'm sure you've had opportunities to discuss that already with some of your larger shareholders. What are you expecting or hoping will happen?
Look, what we would hope is that lots of people would come in to buy and we would be able to issue a lot of stock and get bigger. With markets, you never know. And so much is dependent on what's happening at the time. We're trading at a premium. The fact that people can sell back at minus 2% of net asset value doesn't look very attractive. So, yes, we hope for what we would regard as successful is if we issued stock. Even if it wasn't that much, but it would be nice to issue lots, of course.
Do you have any worries about the budget coming up at the end of November? That's obviously, I think, just after your opportunity comes round.
Yeah, I think the budget is after it. I don't think it affects us as directly. Of course, the uncertainty around changes to things like capital gains tax and all of those things. But that's for everybody. It's not just people like us. And I think we have the advantage that because it's floating and it's short term, and you sort of know what you're getting, and it's relatively easy to get out of assets if you have to. I just think, yes, the budget is a worry generally for the UK economy. I'm an economist, I would say that, wouldn't I? But, we have a cushion in terms of what we invest in and the returns that perhaps others don't.
Let's say there is a lot of nervousness or volatility around after the budget. It could happen. Could have a lot of volatility in the longer end of rates. Could have foreign investors selling UK assets. If you've just been able to issue stock, that's a great time to be buying assets. We like buying assets when others are selling assets, unless it's for credit reasons. But if it's pure mark to market, then the fund has historically done very well out of those periods. Right? You look at 2022, when rates increased dramatically, pension funds have had to sell floating rate assets. That was an incredible time to be buying assets. So I'd see it as a bit of an opportunity as well. And you will see in the fact sheet in the market communication or the market commentary of the fund, if you look at the fact sheet, then positioning is relatively liquid. Gearing is low. There's a lot of flexibility in the portfolio. Most of the bonds that we invest in, you can trade those. So historically, we've been able to move the fund around to find the best relative value. So I'd say, yeah, as much as we're nervous around the budget, potentially also create some opportunities.
So the final question, perhaps to you, Aza, is this. I mean, you obviously manage other funds as well. And as you say, there's a very large market out there with other professional hedge funds and pension funds and so on investing in the kind of things you're investing in. From the manager's point of view, are there advantages from having an investment trust structure? And if so, what are they? And if not, well, alongside that, what are the disadvantages that you see?
There are definitely advantages. So as a firm, we also manage sort of higher rated open-ended structures where you know that pretty much through any type of market, you can offer the liquidity that you need. In an investment company, in TFIF, you know that you've got capital. And the advantage is that I think a lot of assets are liquid until they're not. And investors tend to need their money back when liquidity is no longer there. And I think the advantage for an investment company is, particularly one that sort of operates in semi-liquid markets, is that when others are selling, you have the capacity to go and buy assets at discounted levels. That was the case in 22. It was the case in 2016 when we had the taper tantrum, when, let's say, private credit funds were getting redemptions or hedge funds were getting redemptions or were getting margin calls on some of the stuff that they had on leverage. Those are kind of assets that if you know you've got the long-term capital that you can get involved in and provide a bid on. And those are quite interesting investments. So through the cycle, I think, yeah, an investment company makes a lot of sense when you're investing in that lower rated part of the market. If you're in investment grade, let's say single A's or double A's, you could just run it in a UCITS funds, no problem. And we do that as well. Are there any disadvantages? As a fund manager, probably the disadvantages are, we're a FTSE 250 company. There's a lot of regulation. There's a lot of audit reports that have to be gone through. We write a new prospectus. I'll have to prove every single letter I write. So yeah, there are disadvantages of being a listed company. I think ultimately it's there to protect shareholders.
And from the board's point of view, Bronwyn, what would you say in answer to that question? In other words, one of the differences, you've got an independent board which is carrying the responsibility for looking after the shareholders. And that comes as a price, obviously a cost in shareholders pay. But how do you view that issue?
Yes, there is an awful lot of regulation. And when you sit with the audit committee and the things we have to go through, I mean, we're not a huge company as such. We're a board that employs an asset manager, an auditor, and an AFIM, but you end up, there is such a lot. When I look at the realisation opportunity and the amount of paperwork that's involved, we had a meeting yesterday, and I think there were more than 20 documents that we were looking at. In fact, I know it was more than 20. And so the fact that it does seem a lot, I mean, it does provide protection, but I sometimes think it can make life quite difficult.
Well, I've heard that message before from a number of places indeed. I was a director of an investment trust once myself, and yeah, the sheer volume of paperwork, most of which is either repetitive or redundant, is extraordinary. I guess if you're a government committed to growth, you might be able to make some changes there, perhaps, without threatening the security that shareholders derive from having an independent board. Very good. Well, on that note, I think we should call it an end. I've been talking to Bronwyn Curtis, who's the chairman of 24 Income Fund, and to Aza Teeuwen, who's from the management company 24. So thank you very much. And I should just repeat this compulsory notice that if you want to invest in this particular investment trust, certainly if you invest through one of the larger platforms, you have to complete a form acknowledging that you are investing in what is described as a complex investment.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.